This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 492 was produced on August 7th, 2025. I'm Eric Townsend. Tressis chief economist and fund manager Daniel Lacalle returns as this week's feature interview guest. We'll talk tariffs, recession risks, the European perspective on U.S. geopolitics, markets, and the future of the EU's relationship with the United States. Precious metals, energy, and much more. The nuclear debate I hosted with Mark Nelson and Doomberg for Zero Hedge was very well received, and you'll find the replay link in your Research Roundup email. I'll be hosting another event exploring what it's going to take to really scale nuclear energy up to replace a meaningful amount of the energy we now rely on fossil fuels for. That's coming up next Thursday evening, August 14th at 7 p.m. Eastern Time at zerohedge.com.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, August 6, 2025. The S&P 500 index down 28 basis points, trading to 63.45. First meaningful market correction happened last week, but the question to answer is the correction over or is there more selling to come? We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The US dollar index down 170 basis points, trading to 98.19, giving back almost all the gains from last week. The September WTI crude oil contract down 807 basis points, trading to 64.35, dramatically reversing on the jobs numbers. The September RBOB gasoline down 457 basis points to 209. The December gold contract up 239 basis points, trading at 34.33. It recovered almost all of its losses from the previous few weeks, but we will see if it can break out to that 52-week new high. The September copper contract up 46 basis points to 441. Uranium up 148 basis points, trading to 72.15. And the U.S. 10-year Treasury yield down 13 basis points, trading at 4.23. The key news to watch next week, we have the CPI and PPI inflation numbers, retail sales, and University of Michigan inflation expectation numbers. This week's feature interview guest is Tressis chief economist and fund manager Daniel Lacalle. Eric and Daniel discuss trade negotiations, oil prices, copper, dollar, precious metals, and more. Eric's interview with Daniel Lacalle is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Tressis chief economist and fund manager Daniel Lacalle. Daniel, it's great to get you back on the show. Now, the standard introduction pattern for the first August interview on any financial podcast goes something like, well, Daniel, you know, it's the dog days of summer. There's nothing going on in markets. There's nothing going on in geopolitics. There's nothing going on any place to talk about. What are we going to do? I don't think we're going to have that problem this week, are we?
I don't think that will be the case. There's plenty to talk about.
So why don't we start with the big picture of where we are? And one of the things I really like to pull you in for specifically is we have so many of our American guests. We kind of get an American-centric perspective sometimes from a European perspective, how this is being viewed by the rest of the world. How far along do you guys think we are in this story? Obviously, President Trump and Secretary Bessent intended to go and kind of renegotiate the tariff relationship with the rest of the world. Are they just getting started on policy adjustments, or are they finally wrapping this up?
I think that we are 75% into wrapping it up. Why? Because the main frameworks of agreement have been set up, and I think that by now once the European Union, Japan, South Korea, Australia in agriculture, or the United Kingdom, etc., all have agreed upon very significant changes for the trade relationships. I think that what is basically left is small details, like which sectors are going to be slightly more delayed in terms of zero tariffs in the case of the European Union, or when and where is Japan going to dedicate its 500 billion investment, all these things. So I think that it's basically very, very close to the end of what would be, I would say, a very successful and quick trade negotiation spree. Think about it. It's very, very difficult to achieve so many trade deals in so little time. And obviously, many of them start, like all trade deals, from ballpark and general terms perspective, and then it goes to the finer details. But it's close to 75%, I would say.
Daniel, let's talk about the market cycle as well. We recorded this interview on Monday morning, so we're a few days before the audience. We may not know what the market has done, but last week we had a couple of down days. A few people were saying, okay, finally, this is it. The market is topped. It's all downhill from here. Monday morning, we're actually bouncing a bit, so that hasn't played out yet. Where do we stand in this cycle? Are we nearing a market top, or is it just the beginning from here?
No, I think that we are in an upward trend for global markets, driven by the increase in money supply and driven by an absolutely brutal pace of rate cuts all over the world by central banks. More than 20 central banks cutting rates, and money supply growth at a global level that is rising at around a 12% per annum rate, which is insane. So obviously, those two things added to an earnings season that may not have been the best earnings season ever, but was significantly better in terms of earnings surprise and earnings growth than what many expected. And the fact that a lot of the concerns on the macro environment with these trade deals are sort of left, at least, as something that the worst case scenario is way, way, way out of investors' minds, is going to likely generate a lot of money going back to equities, fundamentally because, as you saw, the record level of money market capital in money market funds was absolutely brutal. So money supply growth, cutting interest rates, and the earnings season added to a more, at least, I would say, transparent or easy to predict macroeconomic and trading environment. All those things indicate that we are in a bull trend.
It's interesting that you focus on how many different central banks are all cutting rates. Of course, on the other side of the pond, we're so focused on the fact that the Fed is not. How is that perceived? Obviously, it's been politicized between President Trump and Jay Powell. From the European perspective, how are they viewing this, and how do you think it's going to be resolved?
For the Europeans and the Japanese in particular, but also for most emerging economies, it is an absolute present. It's a beautiful, beautiful present, because when the Fed keeps elevated rates at the same time as other central banks are lowering them, what it basically means is that for international investors, investing in treasuries is very expensive, and the hedging cost is too high, and it completely eats away the yield of the treasury. Therefore, what the Fed is basically doing is almost an early Christmas gift to emerging economies, the euro and the yen. Remember that the euro and the yen were at all-time lows, the 40-year low of the yen and the euro almost close to parity. And the decision of the Fed to maintain rates predicated on a view of tariffs and inflation that is obviously not happening, and certainly, in my opinion, is quite misguided. It's generating a very, very significant reverse carry trade that is basically allowing a lot of investors to benefit from those elevated rates in the United States in order to look at other options that are not so expensive.
Daniel, I think the criticism that could be leveled there from what you said is, well, wait a minute. What's going on really is there's a political conflict between President Trump and Jay Powell. And at least from President Trump and his camp side, the argument would be, therefore, Jay Powell is risking a U.S. recession through this politicizing of monetary policy. And we have an elevated recession risk as a result. Is that a valid argument? It certainly is a political argument, but does it have any economic merit?
Obviously, elevated interest rates slow down the U.S. economy because we have to remember that the Fed was exceedingly wrong about inflation on the way in and on the way out. And there is something to be said about a monetary authority that is supposed to be using the most advanced technology and predicting applications and methodologies, and got so wrong inflation on the way in and is getting inflation wrong again. So the big problem of that is far more dangerous than just the current debate about whether there should be a rate cut now or not, is that the Federal Reserve hurt families and small businesses in the 2021-2023 period by keeping very, very low rates and maintaining until 2022 the purchases of treasuries and of assets, and therefore being exceedingly dovish in terms of policy. That generated a very elevated inflation. And basically what is going on is that on the way in, families and businesses have been hurt by elevated inflation, and now, on top of that, they're suffering from high rates. My perspective is different from the current debate. It's not whether the Fed should do this or should do that. It's that the Fed should not dictate interest rates. It's that the Fed does not have the tools, and certainly is ignoring all monetary aggregates, and does not have the tools to set rates appropriately. And by doing what they're doing right now, they create boom and bust cycles. So is there a risk of keeping rates high for too long a problem? Absolutely it is. We are seeing it in employment. We are seeing it in investment. Those are areas that are certainly suffering from higher rates. But it's also very important to open the debate about whether the Federal Reserve is doing things appropriately. Because for months, for years, we heard the Fed saying that there was no risk of inflation, and then inflation went through the roof. They said that printing trillions of dollars would not generate any type of inflationary pressure, and that it would be transitory, and it wasn't transitory, and certainly created very big problems for U.S. citizens. So for me, the debate should start to be that the Federal Reserve, like the European Central Bank, etc., should not be fiddling about with interest rates, because they create aggressive boom and bust cycles, and the booms, they don't pay attention to them, and the busts become very, very aggressive. And both of them, both cycles, hurt the backbone of the U.S. economy. Small and medium enterprises and families suffer from the inflationary pressures, and then suffer from the decision to hike rates aggressively when the damage has already been done.
Let's talk about the relationship between the United States and the European Union in the wake of this tariff negotiation. From this side of the pond, Ms. von der Leyen did not really look happy to be caving to a tariff agreement with President Trump and the United States. It appeared that that was kind of we're stuck, we have no choice, we have to make a choice that's unpleasant for us, but let's get it over with. Where does that leave us with respect to the EU attitude toward U.S. diplomacy, specifically with respect to looking forward to the future? A lot of people have said that this Russia conflict, Russia potentially allying with China, is eventually going to force force Europe to sort of choose between the United States as its ally and other allies. How is this being perceived in Europe?
Yeah, I think it's a bittersweet perception of an agreement. On the one hand, it gives certainty and it reduces the risk of a complete debacle. Eliminates the risk of a debacle in terms of trade and in economic terms. And on the other hand, a lot of people are saying, well, we're still getting 15% tariffs, and that is obviously not ideal. Let's start by the last point that you made, which is very, very important within this agreement. In the EU-United States agreement, there are two exceedingly important points. One is the energy agreement, and the other is the microchip and technology agreement. Those two are certainly deals that are going to reduce the possibility of the European Union, let's say, as you said, falling into the arms of China and Russia. The European Union in 2024 imported record levels of Russian liquefied natural gas. And this deal, what it basically shows is that the European Union needs to choose between the United States or Russia plus China. And that obviously, if it chooses the second, that would certainly lead to more aggressive negative position for the European Union exporters. In terms of the deal, I think that it reduces the dependency of the European Union in terms of Russian liquefied natural gas. It also reduces the risk of being dependent on Chinese microchips and technology. And it certainly is hugely beneficial for the United States. But ultimately, what it shows is that the European Union needs to choose between one and the other, because the European Union does not have energy or military or technology leadership. Therefore, unfortunately, the reason why so many commentators are negative about this agreement is not because the agreement is bad in itself. I think that it's a positive agreement. The reason why they're angry is because it shows that the European Union did not have any aces in this game of cards in order to try to squeeze better trading terms from the United States. It did not have, obviously, the possibility of moving its exports to other markets. It is obvious that the EU negotiators at least analyzed that option. It is obvious that the European Union does not have the technology and energy leadership that would give them the advantage to negotiate at different terms. And it's certain that the United States is a much more important market than what we were led to believe in Europe. Therefore, I think that the reason why the European Union commentators and economists are mostly mentioning this agreement as a negative is not because it is a negative, but because it basically simply reveals the truth about the weaknesses of the European Union. And at least from my perspective, this gives certainty and gives a good framework for improving in terms of security of supply, in terms of management of the number of suppliers, and also in terms of reducing dependencies.
You mentioned energy prices a couple of times in there, so let's stay on that theme for a few more minutes. We're in kind of a funny spot here, I think. 66 handle on WTI as we're recording on Monday morning. Really low oil prices considering President Trump has issued a 10-day ultimatum basically saying, there will be hell to pay if there's not a resolution to a war that's been pending for years now. It doesn't get resolved in 10 days. You'd think there'd be more going on, but there isn't. What do you make of energy prices? Where do you think they're headed?
I think that it's clear that OPEC Plus are happy with lower oil prices. If we think about what they have been doing in terms of strategy, it seems counterintuitive, but it actually makes quite a bit of sense. If you think of what they've been doing is that once there was an evidence that there was a significant geopolitical risk building up between Iran and Israel. And if you go back a little bit more than what people believe, this basically came when the Organization of Atomic Energy issued a very aggressive statement, resolution against Iran. Immediately, OPEC announced the largest increase in production that would ultimately absorb any type of geopolitical risk simply by putting in the market 1.5 million barrels a day more than was initially expected. So I think that the strategy from OPEC Plus and from Saudi Arabia in particular, but also from the countries that I would say share the same strategy with Saudi Arabia, is to remain the global central bank of oil and to maintain their position as the supplier of first resort and also as the most reliable and affordable supplier. So the strategy is both to show to consumers that oil suppliers are not going to hurt consumers, that they're not looking to increase prices for no reason, and at the same time to try to show that the alternatives in the energy world are not as affordable and as competitive as some would have expected, particularly in the renewable sector, etc. So the position of OPEC Plus, and I think it's very important to remember that Russia is included in this decision. And I think that what you mentioned prior, which is the strong strategic relationship between Russia and China, is also a way for OPEC Plus to show to China as one of the main importers of oil that they're not looking to hurt them in a situation in which there are these trade negotiations and in which exporters would not be welcoming another abrupt increase in prices. So it's a very interesting strategy that we have seen in the past, in which OPEC Plus is basically trying to prove that they can live with low oil prices and at the same time show to their customers that they're the most reliable and affordable option compared to what obviously from the perspective of OPEC Plus members is less reliable, shale oil or alternative energies, renewable energies.
Now, President Trump has introduced the notion of secondary sanctions. So the direct sanction would be, if we're sanctioning Russia, that means we do something against Russia. The secondary sanction is if we're sanctioning Russia saying they can't sell their oil, then whoever buys their oil against sanctions, we're going to sanction them in order to get even with them. What are the potential economic knock-on effects? I mean, is that just a threat that President Trump is using, or is there a potential here for, India continues to buy a whole bunch of oil from Russia, and then the U.S. actually does something significant in terms of sanction action against India that changes that? Is that coming?
I think that it's very difficult to enforce. I think that it's very, very difficult to enforce because India does not buy Russian oil because of a geopolitical position or because any, let's say, strategic advantage provided by their relationship with Russia. It's basically because they buy any and every amount of commodities that they can from where they can. It's a fast-growing economy with a tremendous thirst for commodities. So I think it's very difficult to enforce. And I think that when I look at it from the way that it has been presented, or at least the way that I've read it, it looks to me like it's a way for President Trump to force India to get a trade agreement as quickly as possible, rather than a fully enforceable sanction package. Because we must also remember from what I said before about the European Union and its imports of fossil fuels from Russia, that in 2024 exceeded the aid to Ukraine, is that it's very difficult to put barriers to such a liquid and global commodity as oil. And obviously, a lot of A lot of oil moves from through different countries, origin washing, refined products, all of that. So I think it's difficult, but I think it's a tactic to do two things. One is to force Russia to reach an agreement with Ukraine to stop or at least reach a ceasefire in the Ukraine war, and two, to force India to speed up its position in terms of reaching an agreement with the United States.
Daniel, I want to get your take on this just huge whipsaw that we've seen in copper. And I want to say specifically, I'm talking about American copper, the HG, Hotel Gulf futures contract, which is for delivery in the U.S. I think that's way out of sync with LME copper. And the reason is President Trump's tariffs. Where do we go from here? It almost feels like so much damage has been done technically to this market. And you can see that it's all as a result of just Trump and Bessent, obviously don't care too much about collateral damage. So I don't think the fundamentals have changed, but boy, on a technical basis, this chart is really, really ugly. What do we do about this?
I think it's very, very dangerous because it's proven that unlike other prices, this was a level of a bullish trend that was very much predicated on expectations of a very, very strong and robust demand in the future. If we think about oil prices, natural gas prices, even aluminum, for example, they tend to move more with changes in supply and demand that are very short-term, more than the long-term perspective. In the case of copper, what we have seen is that the front end of the curve actually was moving very aggressively on expectations of electric vehicles, of expectations of renewable rollout, etc. All these tremendous demand-driven bullish messages. So it seems that it was easy for Trump and Bessent to prick that, let's say, that trend with a couple of messages. Because they were not predicated on, let's say, step-by-step views about supply and demand. So I would be very, very cautious about thinking that this is a bottom and it's going to resume the same bullish trend as we have seen in the past. It may maintain a certain level of strength from the past 5 years, but it's very unlikely to catch up to the levels at where it was only a couple of months ago, because that level, even being on a contract that was supposed to be discounting the supply and demand of 2025, there was a lot of bullishness about very long-term and probably unchanged trends. But I would be cautious to take a bet against something that was so easy to unwind from a few important and relevant messages that need to be included in those assumptions. So I would be cautious about that without ignoring that the long-term aspect of supply and demand for copper remain relatively bullish because there is simply not enough copper at all, and we need to mine a lot more if the expectations of electrical vehicle rollout and renewables rollout are going to be achieved. A lot of people also are starting to question those trends and whether the implementation of electric vehicles on a massive scale was going to be something that we are going to see in 2028, 2029, and maybe moved it to 2035, 2040, which is obviously huge in terms of net present value on the price of a commodity.
Let's talk about how all these policies are affecting the dollar index. It seemed like we were coming out of the Trump and Bessent EU tariff negotiation. Maybe we were about to start the long overdue counter trend rally in the dollar. I thought it was maybe going to have legs. We got a perfect test of 100 on the Dixie last week. Looks like it failed there. We're back down to 98.5 as we're recording on Monday. What's happening here? Is the dollar just in a new secular downtrend that's not going to break, or should we expect some counter trend rallies, or what should we look for?
I think that the problem with fiat currencies is that nobody, no central bank, and certainly no government is defending the purchasing power of the currency. The Trump administration is not particularly comfortable with a weak dollar, but is not comfortable with a very strong dollar either. The European Central Bank and the European Union are perfectly happy if the euro starts to weaken, because it's basically going to be a very significant counter effect to the tariff impact for exporters. And certainly, we don't have to even debate that the Japanese government needs to continue to destroy the purchasing power of the yen in order to maintain the illusion, the monetary illusion of its absolutely nightmare fiscal and debt situation. Being a world of relatives, I think that the bottom of the DXY was achieved once the perception of markets about trade deals was that there was either not going to be any, or that those trade deals would be negative for the United States, which is obviously something that I found quite amusing. But I don't think that we're going to see the DXY go to 110. So I think that the trend, if you look at the trend, it's moving basically like a ladder. Between 2008, 2012, the DXY was much lower than where it is today. Also, at the beginning of the Biden administration, I think that it's likely to remain between the 98.5 to the 100 level. I don't think it's going to go up massively unless the Federal Reserve starts to massively cut rates and leads to a huge move in terms of financial flows into treasuries when hedging becomes much more attractive. And the combination of the hedging cost plus the yield makes global bond investors prefer to buy treasuries than buy Japanese or European bonds. That is something that happened, if you remember, in the path to the 50 basis points rate cut of September, and could actually happen as well if the Fed changes course. But obviously, that is something that we need to pay attention to, because you would need the Fed changing course, and you would need the massive outflow of euros and yens and inflow of dollars from the trade agreements that to kick in. And that is more a 2026 story.
Well, you're lamenting some of the challenges of the relativity of the dollar index relative to other currencies. That, of course, begs the question of precious metals for the absolute comparison. Seems like the gold fundamentals really look pretty strong here. Are we about to see what looks like maybe a breakout of the pattern we've been in, the triangle pattern, and new all-time highs?
I think we will see new all-time highs of gold as the decision of central banks of purchasing more gold and less government debt from developed economies accelerates. We are seeing more and more central banks all over the world balancing their asset base with more gold, less euro-denominated reserves, i.e. less debt, and less treasuries. So I think that that is one element that tends to coincide with the September to December period, which is when central banks try to readdress their challenges in their balance sheet if they have them. And also, I think that it's very evident that the growth in money supply that I was mentioning before, plus the very loose policy of most central banks, would be with the Fed changing course. So if you have all those central banks cutting rates and increasing money supply, and on top of that, you get the Federal Reserve cutting rates and significantly, then obviously that is going to generate a tremendous move into gold in order to generate more capacity for investors to have a stable and decorrelated reserve of value in their portfolios. Most investors remain very, very underweight gold. And at the same time, central banks are purchasing more gold. So I think that gold, silver, to a lesser extent, and even other precious metals, I would look at with a benign view, but more, I would certainly be very comfortable with a long gold position at these levels.
And how do you feel about the reserve currency status of the U.S. dollar at this point?
I think that the reserve currency of the status of the U.S. dollar is unchallenged. The U.S. dollar is the world reserve currency in the fiat world because there is no alternative. If you think about what could be the alternative, the euro, it has redenomination risk. It has enormous fiscal problems, much larger fiscal problems than the United States in countries like France, countries like Greece, countries like Italy, like Spain, etc. And on top of that, it has issued debt, which is let's say, the top of the iceberg. But very few people look at the bottom of the iceberg, which is enormous, which is the unfinanced, committed liabilities of governments, which in some cases exceed 500% of GDP. Therefore, the euro is a great currency and has been doing phenomenally well as a reserve currency despite all of its challenges, but it's not an alternative to the US dollar. To be an alternative to the US dollar, you need to have independent institutions, full transparency in capital markets. Obviously, you cannot have currency controls and capital controls. You need liquid and open capital markets. It's very difficult to be an alternative to the United States dollar in the fiat world. And it's also very evident by now, I believe, that China does not want the yuan to be an alternative to the US dollar. They may want the yuan to be used in more global transactions than currently, but not to be an alternative to the US dollar because they don't want to eliminate the capital controls, the currency controls, the financial controls that they have in their economy. And the idea that Brazil, Russia, India, China, South Africa are going to create a currency that will dethrone the US dollar is also very, very challenging, simply by looking at the way in which their own state-owned exporting companies behave, which is to continue to use the US dollar in everything that they do. And also, from my personal perspective, which is an unpopular opinion, but that is obviously why I give my opinion, I don't think that China wants to have a currency with Brazil, Russia, India, and South Africa. I think that China wants to increase the use of the yuan with those countries, but not adopt their inflation and monetary policies within a similar framework. I don't think that the Chinese government sees itself as one that is going to relinquish their position to provide some escape to the inflationist policies of Brazil, for example.
I want to run a thought experiment past you, because first, I agree with you. The only reason, or the primary reason, that the U.S. dollar is still the world's global reserve currency is because there is no viable alternative. What if I were to suggest to you there is a viable alternative? It's stable coins that are tied to the U.S. dollar. Well, you'd say, wait a minute, that's not an alternative because it's still the U.S. dollar. The stable coins are backed by U.S. dollars. They still create demand for U.S. treasuries. Yeah, okay, I get all of that. But think about the reasons that we care about this reserve currency status in the first place. You think about Triffin's paradox and the issuance of currency and the demand and so forth, the creation of artificial demand for the reserve currency by the rest of the world. Hang on a minute. If what is actually being used as the reserve currency are stable coins, it's not the reserve currency issuer, but rather the stablecoin issuer that's going to start to derive a lot of those benefits of being the reserve currency issuer, or a lot of the benefits that we've historically associated with being the reserve currency issuer, having essentially an unlimited amount of demand where, economic fundamentals don't necessarily matter, just everybody has to have US dollars. All of a sudden, what if it was everybody has to have your stable coins? I think that changes the game. What do you think?
No, I think that it does. I think that it's quite a long-term option, obviously, but I think that decentralization is certainly the future in the monetary system. The reason why we find it difficult to believe that there's going to be an alternative to the US dollar or alternative to the euro, etc., is because we need to sort of think of this matrix type of construct, which is the fully centralized monetary system. But what you very well say is that if stable coins take the place of the US dollar, they would continue to support the US dollar as, I would say, the leading fiat currency, but the benefits of being the reserve currency would be in the country and the issuer of those stable coins. And obviously, the underlying asset can also change, can move to be gold or others. I agree that is a likely option, but it requires a number of steps, a number of significant steps, which include the fact that you could, for example, have multiple bank accounts in multiple currencies and trade between them. That is obviously something that needs to be looked at from the perspective of, what is the future going to look like? But it's obviously a long-term future because the commercial banking world as we know it and the monetary system as we know it, all of them work in this fully centralized position. But certainly, what I would say is the following, is that the rise of stable coins is a very good idea that the US administration has in order to cement the position of the US dollar within the fiat currency world and to maintain and strengthen the demand for US treasuries. No question about it. But obviously, the future would be that those stable coins, and definitely the ones that reach enough level of liquidity to start to be viewed as pure currency, i.e. reserve of value, unit of measure, and generalized mean of payment, all those are something that is going to come from the decentralization of the commercial banking system and the decentralization of the way that we look at money. I think it's inevitable. But am I going to see it in my lifetime? Maybe, but certainly not in the next 5-7 years.
Well, Daniel, I can't thank you enough for another terrific interview. But before I let you go, please tell our listeners a little bit more about what you do at Tressis, also your Twitter handle and so forth, how they can follow your work.
Thank you very much. It's been a great conversation. My work is I'm the chief economist at Tressis. I'm also the CIO of Alpha Strategy Consulting, providing strategic and macroeconomic advice to numerous companies. And I'm not just the chief economist, but I also supervise and advise in terms of the funds that we manage. The way to find me, it's very easy. You have 2 Twitter accounts, X accounts, one in Spanish, one in English, at Lacalle in Spanish, at Lacalle _IA in English. And you also have my website, which is also in Spanish and in English, and my YouTube channels in Spanish and in English. So as I always say, it's easier to find me than to avoid me. Just key in Daniel Lacalle in Google and you'll find all the alternatives. But always remember that if you come across the Spanish language one, there is an English one as well available.
Patrick Ceresna and I will be back as Macro Voices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Daniel back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Daniel's picture saying, looking for the downloads.
Well, Patrick, the S&P started to turn lower last week, but it only got down to 62.80 or so before they bought the dip, and, well, already we're 100 points higher, give or take, at recording time. What comes next for the S&P?
Well, Eric, the jobs numbers last week finally triggered a market correction. We were 300 S&P points above the 50-day moving average, a typical overbought state that has mean reversion. Now, we weren't bearish thinking that there was a massive decline, but these kind of 5% market corrections back toward the 50-day moving average are commonplace throughout the course of a year as these bull trends happen. So we got this peak to trough correction of about 3.5% in 2 days, and the market is recovering here. Now, this is actually going to be a very important moment because if we are transitioning from the bull phase into much more of a distribution phase, which is associated with topping formations and trade ranges, which is an example of what essentially happened starting in November of last year into February of this year. That was like a 3-4 month kind of trade range with a ceiling on the market. Will we see that develop? We are now slowly approaching the period where a lot of these vol targeting funds are completing their buying. We saw some spikes in volatility. The VIX got up to about the 21 level, and most systematic strategies have already done most of their buying. So what will be the next incremental gain? Well, we now have the odds of a recession increasing, the likelihood the Fed is now going to be cutting 3 times this year appearing in the market. So a lot of these headwinds could make the market heavy. Now, typically, if we see the resistance start to come in around that 6,500 level on the S&P, and this becomes a point of resistance for the markets throughout the month of August, then we can start talking about what in September, October could, from a seasonality perspective, bring about a deeper or more meaningful market correction. But right now, that information is all going to be revealed in how the market behaves up along these highs. All right, Eric, let's move on to the US dollar.
Well, Patrick, our regular listeners know we've been waiting for and talking about the formative counter-trend rally in the dollar index. It failed. It was rejected right at round number resistance at 100 even on the Dixie. Already at recording time, we're back down to trading on a high 97 handle. So all indications are that the counter-trend rally that you and I both thought might have legs to 102 or 104 may have already failed at 100 even. This says to me that the structural bear trend is probably back on, meaning more downside for the dollar and probably upside for gold as well.
Well, Eric, on page 3, we have that chart of the dollar. And what I want to really highlight was that we had a legitimate attempt for the US dollar to rally. We basically spent a better part of 6 months in a downtrend, trading decisively below the 50-day moving average. And the dollar stabilized throughout the month of June, July. And we saw a basing, and we saw the first attempt to squeeze above the 50-day moving average, breaking to a higher high. These things typically would trigger a feedback mechanism of a buying and a short squeeze. And it really did feel like it was underway until that very negative jobs number hammered the dollar. I mean, now at this stage, it's clear that the Fed is going to have to ease a little bit more than expected. That has to start being baked into the cake. And the dollar has weakened on that. The interesting part here is that the dollar has now almost wiped out all of its bullish advance that it had in the prior week. And so we're in a situation where, was this one big fake out breakout? And is the prevailing US dollar downtrend that's been in place all year going to maintain and continue to trend lower? The first sign will definitely be a breakdown to the 97 level on the Dixie. But then really what we want to see is the characteristic of failed rallies, quick distribution into any strength, the type of price action that is saying that the situation is deteriorating for a further breakdown. Another leg down in the dollar index, if that becomes the unfolding reality, does measure all the way down to the 95 level on the downside of the Dixie. All right, Eric, let's talk about crude oil.
Patrick, Wednesday afternoon's dip was a perfect test of the contract 100-day moving average at 63.63 on the September WTI delivery contract. I used that weakness to add to my time spread trade in both size and duration of the spread. But as far as directional trades, I think the Trump administration still intends and probably has the political support and friends in high places and OPEC places that they need in order to get lower oil prices. I don't think they're going to flip the curve into contango. And I think that if we do get those prices, it's really going to be an even better opportunity on this time spread trade that I've been discussing. So I'll continue to cover that in future weeks. But for me, no directional trade at this point.
Yeah, similar to the dollar, the moment that jobs numbers came out, the dollar took it on the chin. The interesting part here is that we've now come right to the bottom of the trade range that was essentially established throughout June and July. We obviously had that Middle Eastern confrontation spike in crude oil. And since then, this is $64, $65 level has been the base. And the question here is that with the recession odds now increasing, clearly the question is that will there be less oil demand? And does that create a situation where oil can actually break down this key support line? My entire thesis up until that jobs number was that we're going to find a new elevated higher level of crude oil in a trade range. But with a deterioration to the bottom end of this range, we are at the cliff's edge to find out if the support lines don't hold right at these lows. The technical measured move is for a double bottom retest of that $55, $56 area. And while that wasn't the scenario I was looking for, if that support line breaks, it's going to become the most probable outcome that we're going to be able to see in what's next. Overall, I think that these are still great levels to own oil in the longer term, but on the short term, this may not be where the trade is. All right, Eric, let's get your thoughts here on gold.
Well, Patrick, the gigantic contract roll premium basically saved the day for the continuation chart. The contract chart really wasn't looking good. We had a firm technical level at 3,300. We were not holding that level as we recorded last week's podcast, but the contract roll got us back well above that key level. So now the continuation chart actually looks pretty strong, even though the contract chart for the expiring August contract didn't look so strong as the continuation chart looks. Ultimately, I expect that we're going to break above this level, and then there's going to be another pause at 35.08 or so, which is the all-time high resistance, and then finally a breakout from that previous all-time high to a new target somewhere in the 37.50 to 39.50 range. But there's still plenty of room for another test of the 33.50, that's 3350, lower trendline support on this triangle pattern that we have in the daily chart before this is over. And frankly, the high and wavering slow stochastics on that daily chart are suggesting that a head fake lower might actually be needed in order to shake off those overbought technicals before this market is ready to break higher. So it looks like there maybe is another swing lower on gold before we eventually break upside out of this triangle, but at least it's looking like we're above all those short-term moving averages. The more likely breakout direction is upside as opposed to downside as it was starting to look last week when we recorded the show. And then finally, the 100-day moving average on gold is rising through 32.85, 32.85. So if we had a deeper bearish pullback here, a test down to 32.85, just below that 3,300 level, again to test the 100-day moving average before finally breaking higher, that would certainly make sense as well. So 32.85 would probably be, if we saw another counter-trend move in the dollar or some other policy move from President Trump that was short-term gold bearish, that would, I would say, be another buy the dip opportunity level, 3285.
Well, gold just proved to be in one big trade range. It traded right to the bottom end of the June low. And once that dollar broke down, shot right back up to its highs. The more interesting thing is to seeing how the gold miners, which had a good earnings season, broke out to fresh new 52-week highs and were almost like leading the way for gold futures. Is that an indication that breakout to 52-week highs is imminent? It's the thing to watch, because if gold does manage to make that technical breakout and hold it, the measured moves are all the way to 3,800 to 4,000 on the upside. It'll be very interesting to see whether or not this is the time frame from which that bull breakout will engage. We are right there up along those highs, and so this is probably not going to take more than a week or two to resolve itself as to whether that big breakout is underway. All right, Eric, what are your thoughts here on uranium?
Well, Patrick, sure enough, my jumping the gun last week and also invoking superstition and joking about it on the air, saying I knew that by going ahead and buying the last of my position, I would miss the buyable dip. Sure enough, that's exactly what happened. I brought on the buyable dip. But I think it's really interesting that, number one, that buyable dip was only about a 4 or 5% buyable dip. Maybe it was 6 or 7. I'm not sure. It had fully retraced by recording time, and I won't be surprised if we're looking at new cycle highs on the URA ETF over $42 by the time our listeners hear this podcast. So a deeper correction is still possible at this point. The big upside catalysts are not really expected until late Q3 and into Q4. But overall, my take is that it's game on for this bull market. I'm glad that I have my full target position on. I don't mind if I have to ride out some more volatility from here. If we really get a deep dip, I'll probably buy some more and increase the size of my already overweight position.
Well, Eric, for me, it continues to be two different stories between the equities and the spot prices of uranium. And so just starting off, I have that chart on page 6 of the Sprott Physical Uranium Trust. And to me, technically, this is still actually very bullish. And more importantly, a very early stages bullish. We had a 15-month bear market decline that wiped out close to 50% of the value of that Sprott Physical Uranium Trust. And since then, we have now technically broken out of that bear market decline. And so far, the dip has actually been very well defended right in the retracement zones and is actually technically trying to turn up. This is a classic buy zone for an upside breakout on physical uranium. Now, on the equity side, though, uranium equities had just an extraordinary bull run, and we're much overdue for some sort of a reversion or correction. We're going to see how deep that correction goes, but if uranium itself starts to bull higher on a turn, then that correction will almost certainly just manifest itself as a key buy on dip opportunity to get some exposure on the dips.
Patrick, I can't decide how to interpret the technical indications or the importance of the technicals as they pertain to this copper market. So I am seeking your advice as the technician in the house on how to interpret this. On one hand, it is crystal clear that the whole reason for all these big moves on copper, both up and down, $1.50, just unprecedented moves. It's not because of any economic fundamental anything. It's because the President of the United States decided not to worry about the collateral damage that he was causing by negotiating in a style of bluffing where he pretended to be imposing a tariff that he really had no intention of imposing. That whipsawed the market up and down a few times, and it's pretty clear that copper negotiation is over. It's behind us. We should pretty much write that off and say it's done. Okay, it's so tempting to just say, okay, it's an incredible buy the tip opportunity here because it's a super strategic long-term resource that just got whipsawed around so badly and beaten up so badly by the president's I would say somewhat reckless negotiating style of foreign diplomacy that the technical chart just got artificially beaten up. But one of the rules of technical analysis is you're supposed to just say the chart is the chart. You don't try to get fancy and write off what the chart is telling you. And this chart looks to me like a nuclear bomb just went off. There's nothing about it that's bullish. So, Patrick, I don't know how to reconcile my temptation to buy this dip in size because, frankly, it feels to me like a fundamental bargain here. I really think copper is a very, very strategic a commodity, unless you think that we're starting to plunge into a global recession, which I do not think we're about to plunge into. I just don't see how you don't want to be long copper here. On the other hand, this chart is telling me nuclear Armageddon. How do I interpret it? What should I make of this?
Well, Eric, first of all, technically, it's actually a very hard chart to read because when you have a tariff-driven gap of that kind of magnitude, both higher and lower, it's hard to see actually where the flows and trends really are. The only thing that is legitimate at this point is support resistance lines. And with the fact that we gap down into the low $4 range, we have a major $4 support line that was established in 2024, the lows both in late July and the lows as well through November and December. And so at this stage, it's very likely copper is going to hold those lows on any downside. So the asymmetry of the opportunity exists that you're essentially buying support lines, anticipating that a move in or a bounce in copper here could work its way back towards $5 on the upside. Nonetheless, it is certainly a reasonable proposition, but you really do at this point have to technically be leaning on that major support line.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Yeah, Eric, I want to touch on these yields. And what we can see is that the 10-year yield decisively broke down on that jobs number. It's clear that there's an increased odds of some sort of recession based upon the revisions. And so this type of a breakdown means that the pressure for higher yields has now dissipated. The question, though, is that will we see 10-year yields get back to levels where they were last year, where we were trading down around the 360 level on the downside? At this moment, there is definitely a breakdown in these yields. We'll see whether or not they sustain down here below this 430 area, 435. And if they do, definitely vulnerability down to 4% or lower is entirely on the table. Moving on, what I wanted to just show on page 9 is how dramatic of a pivot there was on the probability of a September rate cut. When we were talking about this last week before the jobs numbers, there was better odds than not, actually, that they were not going to move in September. Literally within 1 week, the odds of a September cut has now jumped to 93%. And so we have a clear weakening of the numbers and data to the point that the Fed is going to have to start to ease. And so the bigger question also therefore is that will that result in some sort of economic slowdown? Because the Fed has historically kept conditions always too tight, too long, and inevitably spurred economic weakness cycle. And are we going to see this scenario where, in fact, some sort of a recession has emerged and the Fed will be late to the game, proving that there was some form of a policy error in them waiting this long to start to act? Now, one of the interesting ways to play that is looking at the 3-month SOFR futures out to December 2026. Now, these basically priced in 25 basis points almost instantaneously on last Friday. But if, in fact, there is going to be some sort of more prolonged or deeper economic weakness, the question is that will the Fed rate cuts be deeper, especially if there's potentially a more dovish Fed chair put in the middle of next year? And so with this scenario, the question becomes is this a trade where we could see the SOFR futures trade up to the 98 level, which would essentially be implying rate cuts that could be as low as 2%. And this may be a really interesting trade to continue to watch to see if the market is going to be pricing in a much more dovish Fed next year.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find a transcript for today's interview, as well as a chart book we just discussed here in the Postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. And you can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.